All right, welcome to Talk Tickers. Today, we are diving deep into AbbVie's third quarter earnings. And folks, this one was a real head scratcher. On the surface, it looked fantastic, but the stock took a nosedive anyway. So what's really going on? Let's get into it. So here's the central puzzle. You look at the results, and they crushed it. They beat on earnings, they beat on revenue, and they raised their guidance for the third time this year. You'd think the stock would soar, right? Nope. The market reacted by selling off, pushing the stock down about 4.5%. So what gives? How does a company report such a strong quarter and still see its stock fall off a cliff? That is the big question, and that's exactly what we're going to unpack right now. Okay, so first let's look at the good stuff, the bull case. This is all about the company's fantastic performance, the numbers that had everyone so excited before the market opened. The headline number that really jumped out was the adjusted earnings per share, or non-GAAP as they call it. It came in at $1.86. Now, Wall Street was expecting something around $1.77, so this was a really solid beat, no two ways about it. And you can see exactly where that strength came from right here. The company's core businesses were just firing on all cylinders. Their Immunology division, up 12% year over year. And Neuroscience, a massive 20% jump. That kind of powerhouse growth was more than enough to cover for the little slump they're still seeing in their aesthetics business. And if we zoom in on that Immunology strength, you see these two superstars, Skyrizi and Rinvoq. Skyrizi was up 47%, and Rinvoq up 35%. This is a huge deal, because these are the drugs meant to fill the giant shoes of Humira after it lost its patent protection. Operationally, you just can't argue with it. The company is executing beautifully. Okay, so if the business is running so well, why did the market get so spooked? Let's flip the coin and look at the bear case, because this is where the story starts to get a little complicated. And here it is. This is the number that made everybody hit the brakes. While those adjusted earnings looked great, the official, by-the-book accounting number, the GAAP EPS, was just 10 cents. That's a staggering, almost 89% collapse from the same quarter last year. Ouch. So what on earth happened? Well, the culprit was this massive accounting charge for something called IPR&D, in-process research and development. Think of it this way. AbbVie went shopping for some new science and new drugs. But because that tech isn't approved yet, the accounting rules force them to take this big non-cash hit on paper right now. And it was a huge one, about $1.50 per share. So at the end of the day, investors really focused on three main worries. First, that huge accounting charge that just made the official earnings look awful. Second, the ongoing weakness in their aesthetics business, the one that includes Botox. And third, even though they raised their guidance, it still wasn't quite as high as what some of the most optimistic analysts were hoping for. But management didn't just take this line down. On the earnings call, they came out swinging with their own side of the story. So let's look at their counter-narrative and how they tried to signal long-term confidence. The CEO, Rob Michael, set a really confident tone right from the get-go. He basically said, hey, our actual business is doing better than even we expected. And he pointed to that guidance raise, again, the third one this year, as proof. He was pretty much telling the market, look past the short-term accounting noise, look at the real business. And it wasn't just talk, right? They backed it up with actions. They signaled their confidence in four really clear ways. They bumped up the full-year earnings forecast. They announced a 5.5% dividend hike, which investors love. They kept talking up their strong R&D pipeline, and they made it clear that growth is coming from lots of different places now. So we've got the bull case, we've got the bear case. Where does that leave us? Let's put it all together and come up with our final verdict on the stock. And really, this is the tug of war right here. In one corner, you've got this amazing operational growth from their star drugs, a super confident management team, and a solid pipeline. But in the other corner, you have this messy accounting charge, a consumer-facing business that's still struggling, and a market that is clearly feeling pretty skeptical. So when we weigh everything, we're landing on a market perform reading for AbbVie. The momentum in their core drug business is absolutely impressive. But that near-term drag from the aesthetics division, plus all this accounting complexity, is probably going to keep the stock trading pretty much in line with the rest of the market for a while. So what should you be watching for? Well, looking ahead, we expect the stock to kind of bounce around in a range. The key thing to keep an eye on is whether Skyrizi and Rinvoq can keep up their incredible growth. And the real wild card? Any sign at all that the aesthetics business is finally hitting a bottom. If that happens, that could be the spark the stock needs to break out. And finally, let's wrap this up with a plausible trade idea based on all this analysis. You know, the kind of thing you might hear being kicked around on a trading desk. The big idea here is simple. Bet on the company's powerful cash flow and just ignore all the short-term accounting noise. It feels like the market is obsessed with that non-cash charge, but it's forgetting that AbbVie generated about $13 billion in actual free cash flow in just the first 9 months of the year. So one way to play this could be selling cash-secured puts below the current price. It's like you're getting paid to agree to buy a great company and an even cheaper price if the market stays pessimistic. And of course, we have to say this loud and clear, this is not financial advice. This is for informational and educational purposes only.